Hello friends, now we will start the chapter number 3, Stop Loss and Limit Order. Stop loss is always used to minimize the risk. You have to have it when you trade. Even if you are an intraday trader and you sit at the computer and watch the price movement and all your positions are closed at the end of the trade day, even though you have to take a stop loss position. Stop loss position is very important. Sometimes having a tight stop loss will be nothing but a loss because it will be triggered even when you choose a right direction. Stop loss should be placed in a position that will be triggered only when the direction you have chosen is absolutely wrong. For example, the price is going up. You wait for a reversal signal. The price changes its direction and starts going down, and you take a short position. So, the high that the price has made before it starts going down is called the resistance. Sometimes it is realized that taking a short position had been a wrong decision and price will keep on going up. It starts going up and breaks the resistance. Breaking the resistance means that it goes up and goes higher the point from where it had changed its direction and went down. Otherwise, you have chosen the right direction. Place of stop loss. Place of stop loss should be chosen very wisely to minimize the risk. It is usually a few pips above the peak resistance plus the spread. When you take a short position, you have to add the spread of the value to the point you have considered as a stop loss, because when you take a short position, you have to buy to close the position, and when you buy, you have to pay the spread to the broker. So, your stop loss should be a buy order and you have to add the spread to it. This is very important when you trade with the currency which has a high spread. If you don't do that, your stop loss will be triggered soon even when the price has not reached the peak. But when you take a long position, you don't have to take the spread because you paid it when you bought. Let's take an example. Let's say I have taken a short position at 1.3120. Let's say that the position I have taken is wrong and the price is moving up. It is considered that the resistance of the price is at 1.3220. So, my stop loss will be somehow 3 to 5 pips above the resistance. So here I add 3 to 5 pips. Now, because the spread is also added, so I'll have to add the spread also. That makes the stop loss somewhere around 1.3220, which is the resistance, plus 5 pips above the resistance, plus 8 the spread, which makes a total 1.3233. So 1.3233 is the stop loss position of my trade. The next part is move your stop loss. When you see that the price moves to your favorite direction and you are making a profit, you should cancel the primary stop loss and set another one higher than the primary stop loss. For example, you have bought Euro USD at 1.4246 and your primary stop loss is at 1.4588. The price goes up for 50 pips. You will have to move your stop loss 50 pips higher, which is 1.4638. Then if it keeps on moving up for 50 pips more, you will have to move your stop loss 50 pips higher than the second stop loss. This is a good technique to maximize the profit when you see the price keeps on moving in your favorite direction for a long time. But keep in mind that it doesn't mean that you have to wait until the price hits your stop loss. To protect your profit, when you see a clear reversal signal, you should close your position immediately before it hits the stop loss. Limit order. Limit is good thing to fix your profit before you lose it, and of course it is a good thing to limit and control your greed. It is better to keep a trade as long as it is moving to your favorite direction and there's no reversal signal, but you can set a limit and fix your profit. You should not get upset if the price keep on moving to the same direction for several hundred of pips after hitting a limit. You are already out of the game. Determining the limit can be very easy if you make a rule for yourself. For example, if you say, I will be happy with 20 pips and want my position to be closed when I have made it. But it can be hard and complicated if you want to determine the final destination of the price and set your limit according to it. It is always possible that the price doesn't move according to your prediction, and so it changes its direction before hitting a limit, and so you have to be very careful. If you like to earn the maximum profit, you have to determine the final destination of the trend. This can be challenging. First, you have to find all the supports and resistance before setting a limit. Now, let's discuss about money management. Money management in forex trading is one of the most important problems of new and even advanced forex traders. Almost everybody can find a good trading system that can be profitable, but something that causes trader to lose and be negative at the end of the month is lack of the proper money management strategy and discipline. Although money management is so important and critical, it is still very easy to follow. Forex money management have several different aspects and stages and should be started from the very first stages of the live trading. The different stages where money management can be followed are opening an account, choosing a leverage, and taking a position. We will discuss about these stages one by one. The first stage is opening an account. We have a very simple rule that says never risk more than 2% of your money. Most traders think that this rule should be applied after having a live trading account and while they trade. But this is not true. This rule should be considered even when you want to open a live account. Let's say you have already practiced demo and traded enough and you are confident enough to open your live account. Let's say you have $20,000 saving. Would you open a $20,000 account? Well, you can do that, but what if you lose this money for any reason? For example, your broker becomes bankrupt and closes your company and never pays your money back. Or you take a 20 load position by mistake and you forget to set the stop loss. It goes against you for 100 pips and wipes out your account. You won't be able to start over, at least for a long time that you save some money. And thus, this initial failure may have a bad impact on you and you may not think about your forex trading anymore and you will lose the opportunity for good. If $20,000 is the only money you have, you should open a $400 account, especially if this account is your first live account, or a $1,000 account maximum if you are confident enough that you have had enough practice and you know how to trade. Therefore, money management should be considered even before live trading and when you want to open your live account. The second stage is when you want to choose the leverage of your account. Nowadays, you can have even a 1:500 leverage, but this is too big for a new trader and even an experienced trader try to avoid it. A 1:200 leverage is acceptable. For example, if a broker gives you a 1:1 leverage account, then you want to buy a 100,000 US dollars against Japanese yen, you should have 100,000 US dollars in your account at least. But if a broker offers you a 1:100 leverage, then you need to have $1,000 to buy a 100,000 US dollars. And so, with a leverage of 1:500, you need to have only $200 to buy 100,000 US dollars. The third stage of money management is when you take a position. The rule says never risk more than 2% of your capital in each trade. It means if you take a position and it goes against you and triggers the stop loss, you should lose only 2% of your account balance. For example, if you have a $100,000 account, you shall risk only 2% in each trade, no matter what position you take and how big your stop loss is in different positions. You should choose the position size in the way that if your stop loss becomes triggered in any position, you lose 2% of your account. If a position goes against you and you feel stressed at and you go down on your knees and start praying and begging to God to return the market out and you can get out of a break even, it means you have traded with the money that you can't afford to lose, and if you lose it, you will be in trouble. And you have taken too much risk in your trade and you have not followed money management rules. So this brings to the end of the chapter number 3. Thanks for your participation.